Well, thank you so much for having me. I'm also seeing some familiar faces, some familiar student faces, so I'm excited to tell my students about my research. And I'm going to argue that forgetting may actually make people more happy when it comes to their portfolio. So I'm not saying that forgetting is a generally underrated skill, so students, please don't forget about what you learn in capital markets. But I'm saying that it might be an underrated skill when it comes to your portfolios. And this is the very snappy message of my research paper, which title is A News Utility Theory for Inattention and Delegation in Portfolio Choice. And this paper was motivated by a bit of a discrepancy between the empirical evidence of when and how people rebalance their portfolios and the predictions of standard finance theory about when and how people should rebalance their portfolios. So standard finance theory says that people should rebalance their portfolios very frequently in order to reduce their portfolios' kind of overall risk. So they always want to keep their stock and bond share at their optimal level, and that will reduce the portfolio's overall risk. So people dislike risk, so they like to rebalance as frequently as possible. Now, empirically, there are a couple of papers which show that people are inattentive to their portfolios. So instead of rebalancing every day or every week or every month, they rebalance more like once a year. And this rebalancing not only increases the risk of their portfolio, but it has also been shown to matter in the aggregate. So Gabix and Lebson shows that it increases the equity premium puzzle, and Michael Woodward shows that it deepens business cycle fluctuations. So this seems to matter even large scale, so not only for the individual investor's portfolio. Now I'm going to offer a new explanation for why it may be optimal to be inattentive or rebalance infrequently. And this explanation will also going to be informative about a couple of other anomalies which we have documented in investor behavior. So there are a couple of papers who argue that investors overpay for delegated portfolio management. So instead of opening a Vanguard account and investing all their money into a cheap index fund, people hire expensive portfolio managers who may even underperform. And another anomaly is that when people undertake rebalancing efforts in their portfolio, these efforts do not seem to reflect a kind of well-defined portfolio share as standard finance theory would predict. So it seems like a bunch of other things are going on when it comes to rebalancing. So people sell their winning stock, for example, in order to realize the gains, and they hold on to their losing stocks because they don't want to realize their losses. So there's a theory called realization utility, which is really good at explaining people's trading behavior, and my preferences may provide a micro foundation for that type of behavior. Great. A third anomaly is that people seem to treat a dollar of labor income somehow differently than a dollar of portfolio wealth. So they seem to do some type of mental accounting and treat the dollars which should be perfectly fungible as non-fungible in their consumption decisions. Great. So I'm going to offer a new explanation for inattention and demand for delegated portfolio management that is also informative about these other investor anomalies I just introduced. And as Andrew and Mauricio, most of my talk is actually going to be a little bit more background info than actually what I'm doing in the paper and the model and the detailed info. Great. So my explanation is based on a new preference specification, which has been really influential in the micro-literature. And the preferences say that investors not only care about consumption utility, so the standard model always says that investors only care about consumption. So people's happiness depends on what they had for lunch. And when you're poor, you eat a Luna bar for lunch, and when you're rich, you go to the Waldorf and have frog legs. So that is what makes up your happiness. So however, in reality, a lot of other things may influence our happiness. And one thing may be something like news about present and future consumption. So we may be happy when we learn something good about present or future consumption, and we are sad when we learn something bad about present and future consumption. So when we learn that we're going to get a stipend next year, we are happy now, and we are not only happy when we are able to afford more consumption next year. And another crucial assumption of these preferences is that people dislike kind of bad news about present and future consumption more than they like good news. So people are more upset when they learn something bad about the future than they are happy when they learn something good about the future. And this is a very important assumption within these preferences because it's inspired by prospect theory, which is one of the most influential descriptive theories about people's attitudes towards small and large-scale gambles. So when you offer somebody a gamble, like a lose $1, gain $2 gamble, then we observe that people are risk-averse to these gambles. So they may reject a lose $1, gain $2 gamble. However, and I'm going to explain that in a lot more detail in a couple of slides, that is inconsistent with kind of a standard concave and increasing utility function, which we have calibrated to match, for example, income risk at an annual horizon. Great. So these preferences have been shown to explain micro behavior in a lot of domains. So they have been really influential in the literature. So they explain consumer pricing, cab driver labor supply, real effort experiments, all kinds of different things. So I'm going to take these preferences to a more macro finance environment, which is a fully dynamic and stochastic lifecycle portfolio choice model. And in order to study inattention within this model, I assume that the investor has access to a brokerage account, which he may or may not look up, and a checking account, which he can use to finance consumption when he's planning to not look up his brokerage account for a while. Great. But before going to that model, let me give you somewhat more background info on prospect theory and where the news utility preferences come from. So this is the standard model of utility. So utility, or happiness, is an increasing function of consumption. Makes sense. More consumption makes you more happy. But if you have a lot of consumption, then each additional increment in consumption will make you somewhat less happy than the previous increment. Now, this concave shape implies that the investor is risk averse. And you can have, let's say, the investor is at some initial consumption level, C0, and you offer him a gain of G and a loss of L. Now, the expected utility of this gamble, which is essentially the straight line between the utility values of either getting the gain or losing the loss, is going to be essentially the straight line, the midpoint of the straight line between these two outcomes. So this is the expected utility. Now, the utility of the expected outcome of the gamble is here. And this is much higher than the expected utility of the gamble, which is saying essentially that people require a risk premium. They require G to be higher than L in order to accept a gamble when they have a concave utility consumption function like this. And the risk premium they require is going to be proportional to this gap between the straight line and the expected utility, or the utility of the expected outcome versus the expected utility of the gamble. Great. So when we take this curve and we calibrate it to, let's say, life cycle income risk at an annual horizon, then we kind of offer this person a small scale gamble, something like lose $1, gain $1 and 1 cent. Then this person is always going to accept any small gamble, because essentially when you zoom in here, the concave utility function will be approximately linear, which means that the agent becomes approximately risk neutral, and the risk premium goes to 0, basically. So at some point, the agent is going to accept any positive expected utility gamble. Great. And that is a problem to some extent, because there's a lot of evidence that people are risk averse towards small scale gambles. So there are a lot of evidence that people may reject something like $1, lose $1 and gain $2 gamble. And this is because they are loss averse. So they dislike losses about twice as much than they like gains. Or you dislike losing $10 about twice as much than you like finding $10. Now, what we have to do in order to kind of reconcile small-scale risk aversion with reasonable large-scale risk aversion, because when you calibrate this curve in order to have a positive risk premium for something like a very small-scale gamble, lose $1, gain $2, then your curve will imply an agent who is insanely risk-averse relative to large-scale gambles. So when you then offer, so let's say you have somebody who is just indifferent between taking or not taking a lose $1, gain $2 gamble, when you calibrate your utility function to be consistent with that person's preferences, then he will reject effectively any gamble which is something like lose $1,000 and gain any sum you can possibly imagine. So he's going to be extremely risk-averse towards large gambles, and such a utility function would not be useful in a life cycle portfolio choice model, for example. Great. So what you can do, the solution to this is that you just introduce a kink at C0. And we can see here now that you're can zoom in to the kink, and there's always going to be a positive risk premium because there's a kink in the one curve, and that means that the kink curve is always above the straight line between the two gambles. And this is called loss aversion. So here, the agent dislikes losses about twice as much than he likes gains. And now you can calibrate this big curve to life cycle risk at an annual horizon, let's say, and you can calibrate this kink to be, let's say, exactly indifferent between taking or not taking a lose $1, gain $2 gamble. Great. So now the problem is obviously you can put this kink anywhere, and it's really hard to figure out where the kink should be in order to kind of match your predictions. Another problem is that at this point, for example, the kink is defined over monetary gambles. But in the end, what people care about is consumption and not monetary gambles. So, and these are the 2 points which the preferences I'm going to talk about today can help us with. So they are defined over consumption, and because people care about news, so they care about the news of having $1 less of future consumption today, and they care about the news of having $2 more of future consumption. And they are loss averse, so they dislike the bad news twice as much than they like the good news. Then we can have preferences which are consistent with people's attitudes towards small-scale gambles as well as kind of large life cycle risk. Great. So just a little bit of terminology. So loss aversion, or a kink in the utility function, is called first-order risk aversion. First order because even when risk becomes really small, like a lose $1, gain $2 gamble, the agent is still going to be risk averse to it. Whereas just a concave utility function is second order risk aversion, because when the risk becomes really small, the aversion to the risk also becomes very small and vanishes in the limit. Great. So I have 5 more minutes or so, right? Okay, good. Great. So now I'm going to torture you a little bit with the functional form of the preferences. So this is going to become ugly, but I'm going to try to explain each component in detail. So the preferences are defined over news. So they are defined over expectations as well as consumption. So let's first explicitly define what I mean by the agent's expectation about consumption in period t plus tau from the perspective of period t. So these expectations are denoted by f ct plus tau t, and they are simply defined as the fully probabilistic distribution function of ct plus tau consumption based on the period t information set. So the agent has rational expectations in the sense that he knows exactly how much consumption he's going to have in each state of the world, and he's going to take that into account. Now, the agent instantaneous utility in period t, so this is the agent's happiness in period t, depends on consumption utility as in the standard model. So this is some concave function of how much you had for lunch and whether it was a lunar bar or frog legs at the Waldorf. And then the second consumption component, and this is new, is news utility about present consumption. So here the agent compares his period T consumption to his expectations about period T consumption formed in period T minus 1. Now, the third component is news utility about future consumption. So here the agent considers all his future periods of life, and when he has learned something good or bad about future consumption, then he's going to be either happy or sad. So this is captured in the third component here. Great. Now, I'm not going to explain this because I'm running a little bit out of time, but the idea here is that we want to have a model which is consistent with people's attitudes towards small and large-scale consumption gambles and wealth gambles. So we know from laboratory studies how the average person reacts to a small-scale gamble, like lose $1, gain $2. And we want to have a model that is consistent with those risk attitudes. At the same time, we want to have a model that is consistent with life cycle consumption risk at an annual horizon. So this is achieved by these preferences because they are loss averse. So they have this loss aversion component in the sense that the agent has a larger utility decline in response to bad news than a utility increase in response to good news. Now, another thing which these preferences achieve is the second kind of really big observation about human behavior, which seems to be, which is not captured by the standard model of utility. And that is so-called hyperbolic discounting. So hyperbolic discounting says essentially that I may now make a choice which is not consistent with my behavior or my future behavior anymore. So for example, I'm now saying, okay, so I'm going to eat one more brownie, and that's the last brownie. And I want my future selves to not eat any more brownies. However, my future self may be like, oh, one more brownie, that would be great. And so he's getting another brownie. And then he wants his future self to not eat any brownies anymore, but the other future selves may kind of see that differently. So this is something which is not present in the standard model. So the standard agent's self today will always want the same thing as his future selves will want. However, this is a problem in this model. So these preferences kind of achieve the two main deviations of risk attitudes and time attitudes or preferences over consumption trade-offs, intertemporal consumption trade-offs, which we have found to matter in microeconomics. Great. So now when you incorporate these preferences into a life cycle model where the agent has this opportunity to be inattentive, then he's going to be inattentive most of the time. And the reason is that when he looks up his portfolio in his brokerage account, he's going to receive good and bad news about future consumption because he's going to learn the realization of the stock market and he's going to learn the realization of his wealth. And he always dislikes the bad news more than he likes the good news. So that means, on average, looking up the portfolio is painful or results in a first-order decrease in expected utility because the agent is first-order risk-averse. So now, don't looking up the portfolio results only in a second-order decrease in expected utility because the agent cannot smooth consumption perfectly anymore because he doesn't know what exactly is going on with his wealth. But he trades off kind of the first-order cost to the second-order benefit of monitoring his portfolio constantly. And then he optimally decides to be inattentive for a first-order period of time. Great. So, and given that rebalancing very often results in a reduction of risk in the portfolio, and this agent is first-order risk-averse, he also has a first-order willingness to pay somebody else, and that could be a person or an algorithm, to rebalance the portfolio for him. So even small improvements in the risk-return trade-off are going to elicit a large willingness to pay because the agent is first-order risk-averse. And then he may not participate in the stock market at all. He's going to have low stock shares, and he can diversify across time. So this is interesting. Time diversification means that you think that the stock market is less risky at, let's say, a 1-year horizon than a 1-month horizon. And this is not going to be true for the standard agent. So the standard agent would invest the same share of his wealth if you would invest for 1 month or 1 year. Now, the news utility agent thinks that the stock market is much more attractive at a 1-year horizon. And the reason is that his first-order news disutility from finding out how the job market paid out is a first-order effect, so it's proportional to the standard deviation, whereas the expected return or the benefit of the stock market is linearly increasing in the horizon. So the expected return is increasing by 12 when the news utility agent considers a 1-year investment horizon, but the news disutility from finding out that you have lost all your money is only increasing by square root of 12. So it increases at a slower rate, so to say, than the benefit of the stock market. Great. So I have a bunch of other predictions about rebalancing and mental accounting which speak to these other anomalies which we have documented about investor behavior. But I don't have time to talk about them, but I would encourage you, of course, to read the paper. So this is my part, and I hope you enjoyed it.